It is time now to buy Lockheed Martin. We are going to discuss in today's episode why it is a strong opportunity to buy this incredible company, which is undervalued by the market and has some strong upside. We're going to look at the historical performance of LMT. We're going to jump into the company's income statement, look at their top line growth and bottom line net income growth year on year. We're going to take a quick health check of the balance sheet, looking at total cash versus total debt. We're going to take a look at the insider trading, how much ownership there is, as well as the same for institutions, whether they've been buying or selling. We're also going to take a look at how they compare to their competitors such as RTX, BA, NOC, and how they've outperformed or underperformed them over the last 5 years. We're also going to jump into the dividend safety, looking at some very important financial metrics you need to understand before investing into this company. And as always, we will run it through our stock valuation model, getting to our intrinsic value and our acceptable buy price given that margin of safety. So straight away, it is down around 16% year to date. We can see it towards the end or the lower end of the 52-week range, and it does offer a forward yield just under 3%. Now, shareholders who have been holding the company over the last 10 years would be up a very strong 218%. Now, we want to understand in today's episode, can we see the strong growth that it's seen over the last 10 years, over the next 10 years and beyond, and even larger than that? And with a nice yield of 3%, can we expect to see our yield on cost grow into double digits over the next few years? Now, in terms of the income statement, well, how has it essentially performed on the top line and bottom line over the last 5 years? Well, December 2018, they reported 54 billion on the top line. And what we typically like to see is around 3 to 7% growth year on year. So December 2022, 5 years later, latest annual report, they reported 66 billion. So nice growth over the last 5 years. And on top of that, what we can see on a more granular level is an increase in revenue from 2018 all the way to 2021 before seeing it dip slightly from 21 to 22. So a slight inconsistency there on that top line. It isn't growth every single year. And on the bottom line, when we take a look at that bottom net income, we can see 5 billion reported in 2018, 5.7 billion in 2022. So around 15% growth on the bottom line over the last 5 years. But again, a similar story to the top line. On a more granular level, we see the inconsistencies. 2018 to 2020, we see the growth on the bottom line year on year. It then decreases in 21 and 22. So it doesn't also follow that growth of the top line. So slight inconsistencies, but nothing really too dramatic or no massive red flags as of yet. Now, in terms of the health check of the company, total cash versus total debt, 2018, they had around 772 million of cash on the balance sheet. Latest quarterly report, they are holding a significant amount more of cash, 3.7 billion, so 3 billion more of cash over the period. Well, how does that compare numerically and directionally to the total debt? So what we can see here, the total debt, they held around 14 billion in 2018, and in their latest quarterly report, around 17.5 billion. So whilst their total debt has increased, it's increased by roughly the same amount as that cash balance. So again, nothing really dramatic to note there. Now, in terms of insider ownership, what we can see straight away, around 0.17%, so nothing too large in terms of that. In terms of the amount of selling that we can see over the last 12 months, around 2 million, and again, insider buying around 1 million. So nothing really, again, that I would point out here as anything that we need to discuss. Again, as we can see, in Q1 and Q2, there was a fair amount of selling, but also note that there was some buying. And again, in Q3, around 250k. In the grand scheme of things, for this type of company, the size, it isn't too much to note. Now, more interestingly, institutional ownership, very positive to see, around 74% held within institutions. And in terms of comparing the last 12 months buying and selling, we can see around inflows of 7.7 billion, outflows of just under 7 billion. So again, fairly even across the whole last 2 years. In fact, if we want to take a look, we can see again the green representing the inflows, the red representing the outflows. So again, nothing massive to note here. The only thing that I would point out is that it is quite high in terms of institutional ownership. Now, before we move on to the financial metrics and the dividend safety, we can take a look at the total return performance of LMT versus their competitors. So we have a few companies here that you may have heard of: RTX Corporation, Raytheon, which we have reviewed on the channel, Airbus, the Boeing Company, Safran SA, and Northrop Grumman Corporation, all in the aerospace and defense industry and similar size. So year to date, when we take a look, we can in fact see that LMT, as we can see here, the orange line highlighted, hasn't performed that great in relation to their competitors. In fact, they are towards the middle end, negative 14%, with the best performing out of all of them being SAFRY at 25%. Now, when we interestingly compare that over the last 5 years, and when we look at 5 years, we are looking at the total return. So this includes those dividends essentially reinvested. What we can see is when we take that over the last 5 years, essentially LMT has been performing 29.92% over the 5 years. The second best performing in their category, we see a popular company like RTX, in fact, down over the last 5 years. And again, NOC, the highest performing at 43.96%. So again, it's always good to essentially look at the historical data. But again, do bear in mind, historical performance does not dictate future performance. So when we go now and look at the company in terms of the dividend safety and some very important financial metrics, straight away, dividend safety score of 84, making it very safe, and a market cap of just over 100 billion, making it a mega cap company. Now, in terms of how the company performed in the last recession, well, we have some metrics here that we can discuss. Straight away, what we can see, the last recession, they in fact increased that dividend, 0709. Recession sales fairly flat, around negative 1%, but do bear in mind this was above the average growth of companies in the S&P 500, which was negative growth. And we can see recession return negative 46%, when you compare that to the S&P 500, which had a negative 55% return. So again, something to digest for those that believe we're heading into a recession. Now, they have been paying dividend growth streaks for over the last 20 years, and they did recently, in fact, just last week, increase that dividend by 5%. Last 5 years, 9% compounded annual growth. Last 20 years, 18% per year. Now, what do I always say? Well, we do love when companies increase double digits, but at a minimum, I always say to investors, a minimum of 4%, as 4% was the average inflation rate over the last 40 years. If you're not getting a 4% increase in your salary, dividends, or other income producing assets, you are in fact taking a pay cut and losing your purchasing power. So we move on to dividend yield theory, and as we can see, the first thing to note, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. So 3.14 versus 2.66 is our first sign of undervaluation. Do bear in mind though, we don't look at any of these models in isolation, and we'll draw a conclusion towards the end of the episode. Likewise, forward PE 14.7, it's sitting below the 5-year average of 15.5, another sign of undervaluation. And the third sign here with the Lockheed PE at 14.7 versus the sector PE at 17.1. As I mentioned, it is towards the 52-week low, but do bear in mind 52-week low does not signal undervaluation. Likewise, 52-week high does not signal overvaluation. Now, earnings data will always be up here for investors that like to look at that. However, personally, I tend to ignore the earnings as it is susceptible to manipulation by management through accounting and focus more on free cash flow. One example of this is if you look at 2018, you see the earnings payout and be happy at 47%. Whereas if you were to look at the free cash flow, you'd see this well above 100% at 125, signaling that the company in 2018 was paying out more in dividends than they generated in free cash flow. So again, my attention will be on the free cash flow metrics. Below 60% is what we like to see. Why? Personally, I believe that management are then able to offer those double-digit dividends we love to see. Last few years, well below 60%, and even 2023 expected to be 51%. So very positive to see in relation to that dividend. Likewise, EPS data up there for investors who like to see that. I'll focus more on the free cash flow per share. 11.60 in 2013, 23.30 in 2022. Very nice to see the growth over the last 10 years, but bear in mind it is a fairly inconsistent company. As you can see with that free cash flow, some years 2013 to 14 where it drops, some years where it's flat in 15 to 16, and then some years like 17, 18 where it drops. So do bear in mind, whilst over the last 10 years it's going in the right direction, it is slightly inconsistent. Sales growth, as I mentioned, 3 to 7% growth is what we want to see for a company at a bare minimum. And we can see for the large part, they do get that on average. They did have some years in 2013 and 14 with double-digit negative growth, but they did instead recover over that. Numerically, how does that look? Well, 45 billion on the top line in 2013, 66 billion in 2022. So it's positive to see that the revenue over the period is going up in the right direction. But again, it isn't one of those consistent companies where every year you know exactly what that increase will be. Now, one thing it is nice to see is that shares outstanding decreasing year on year. Yes, we love it as investors when companies do share buybacks, returning excess cash to our pockets. And as we can see, 327 million in 2013, 265 in 2022. So very positive to see as an added bonus to those nice dividends that we also see. Now, one of my favorite metrics for Lockheed Martin is that return on invested capital, the ROIC, which is one of my 7 golden dividend metrics. What we like to see is a minimum of 10%, as it means management are able to effectively allocate that capital. And over the last 10 years, it's been well above that 10%. Very positive for faith in management. And we can see the last few years between 29 to 49%. So very, very positive. Operating margin, free cash flow margin. For the large part of the operating margin has been around that 12% we look for. Ideally, we would like it to be higher. The higher the operating margin, the higher that bottom line net income margin will be. And therefore, it will essentially mean more dividends to the investors or a higher dividend increase. Again, free cash flow margin, it has typically been above that 5% we look for. But do bear in mind, 2018, we did see it slip, but it has rebounded well from there. Now, finally, not really a worry that I flagged in the balance sheet, given that their debt had increased by the same amount as their total cash, but the net debt to earnings before interest, tax, depreciation, amortization is an important metric, which does then affect that all-important dividend safety. What we typically look for is below 3 signaling the number of years it would take the company to pay off all their debt net of cash on hand. And what we can see here is essentially from 2015, where it was well above that 4, it has started to come down. 2022 at 1.95, 2023 expected at 1.92. Doesn't really give me any worries moving forwards with that dividend safety. They are able to cover that quite well. On the right, we just see the net debt to capital, purely showing us the percentage of a company's financing from debt as opposed to equity. Now, again, as always, if you do enjoy the content, value is being provided, do smash that like button. It really helps the channel and it costs absolutely nothing. And do subscribe and hit the bell button if you want to continue receiving these videos to your doorstep on a regular basis. And as always, if you want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value, whether it's for companies in your portfolio or for LMT, do click on the pinned comment below. So we then move on to Graham's valuation for Lockheed Martin. We have the stock ticker, earnings per share, growth rate per analyst estimates, and that current yield on AAA corporate bonds, giving an intrinsic value of $441 based on Graham's model. Now, do bear in mind the price is currently at $400. However, this video was recorded in the pre-market where we can see it going up to around $420. But again, Graham's valuation is showing $440. So even on that pre-market price, it's still showing a good upside, but it is within that 52-week price range. As always, though, we never look at any of these models in isolation and we'll draw our conclusions towards the end of the episode. Now, multiple valuation model, we're comparing to companies in a similar sector and size, and as I mentioned, we did run through these earlier. We have NOC, RTX, LHX, and GD. We have their stock price, earnings per share, and PE multiple. We get the average multiplied by that of the EPS of LMT to get a stock price of $627, significant upside to the current trading price, and well above that 52-week high, showing signs of undervaluation in the current market. We then move on to the third model, the dividend discount model, where we have the yearly dividends with that 5% increase from last week. Average growth rate, very nice at 7.5%. Forward looking, I've estimated 5.5%. Now, you could argue you could go for a higher or lower depending on your investment thesis. So if you do want to play around with the numbers, do grab a copy of the model to get your own prices. However, based on my estimates and judgments, we get a DDM price of $532. As we can see, some nice upside to the current trading price and slightly higher than that 52-week high, showing signs again of undervaluation. We then move on to the third and final model, the DCF cash flow model, and we can see our discounted or our free cash flows year on year. Average growth rate at 22.8%. Forward looking, analysts are estimating around 6% in conjunction with that discount rate. We get the present value of future free cash flows. We also get the cash and cash equivalents, add that together, subtract total debt, and arrive at the equity value. When we divide that by the shares outstanding, we essentially get a DCF price of $535. Again, nice strong upside to the current trading price and above that 52-week high, again showing signs of undervaluation. Now, the intrinsic value, again, is essentially the average of the models that we've just covered. And as always, if you do enjoy the content, value is being provided. Smash the like button and hit the subscribe if you want to continue receiving these videos delivered to your doorstep. Now, the current trading price is $420, roughly that in the pre-market. As we can see, the markets haven't opened yet, so we're seeing 400. So we'll go with the estimation of the pre-market. So margin of safety, typically I'd advise 10% if it has a wide moat, strong financial metrics, good forward-looking data. So if you were looking for essentially a margin of safety of 10%, your acceptable buy would be up to $480. Now, again, I wouldn't essentially recommend that for LMT. I would go higher. Those looking for 15% would be looking for around $454. Those looking at 20% around $427. And those looking at around 25% looking at $400. Now, personally, 25% I believe is enough for a company like LMT. And I think if you were to get it at $400, that would be a strong price. Now, whilst we can see last week it was around $400, the market is opening at around $422. So do bear that in mind. As always, though, let me know your thoughts in the comments below. Are you looking to buy LMT, looking to sell, or purely on the sideline speculating? And Wall Street forecast over the next 12 months for the price to show some strong upside to around $500. As always, let me know your thoughts in the comments below. If you've enjoyed the video, smash the like button. Also subscribe and hit the bell if you haven't already. And don't forget, if you do want to grab a copy of the valuation model to run your own companies through to get your own intrinsic value, or if you want to run through LMT yourself, do click on the pinned comment below. As always, have a great day, take care, and catch you on the next episode.